On June 11th, 2026, Japan's House of Representatives passed a law that will be remembered as one of the most important regulatory decisions in the history of Bitcoin. And the very next day, June 12th, Metaplanet announced it had acquired a licensed Japanese securities firm, positioning itself to be the first entity in the country to issue Bitcoin-backed financial products directly to Japanese households, one day apart, arguably the most consequential 48 hours in Japan's Bitcoin history. In this presentation, I'm going to explain exactly what changed, why it matters, and make the case for something that I think almost no one is currently pricing, that Metaplanet Securities is on track to become the Goldman Sachs of Bitcoin Treasury finance in Japan. Before we begin, I would appreciate it if you like and subscribe to my channel. This is not financial advice. Let's get into it. Before I explain what changed, you need to understand what the FIEA actually is. The Financial Instruments and Exchange Act, known as the FIEA, is Japan's primary securities law. Think of it as Japan's equivalent of the US Securities Exchange Act. It governs who can issue financial products, who can distribute them, how they must be disclosed, and how markets must be conducted. Stocks, bonds, derivatives, investment funds, they all live under the FIEA. The FSA, Japan's Financial Services Agency, enforces it. Any company that wants to originate or distribute financial products in Japan needs to be registered under the FIEA as a financial instruments business operator, a Type 1 registration, which is what Metaplanet now controls through the SIBO acquisition, is the most comprehensive license available. It covers equity, fixed income, derivatives, and structured products. The FIEA is not just a compliance checkbox. It is the legal architecture that determines what products can exist in Japan, who can sell them, and who can buy them. And until June 2026, Bitcoin was not inside that architecture. Until this amendment, Bitcoin was not a financial instrument under Japanese law. It was a payment instrument governed by something called the Payment Services Act. The Payment Services Act was introduced in 2017 after the catastrophic collapse of Mt. Gox in 2014, where approximately 850,000 Bitcoin were lost. Japan needed a framework to regulate crypto exchanges, and the PSA was it. But the PSA treated Bitcoin like a very complicated prepaid card, a digital tool for transferring value, not an investment product, not a security, not a financial instrument. Now, here's the specific problem this created for Bitcoin-backed bonds. A bond backed by Bitcoin collateral sits at the intersection of two laws, the FIEA, which governs the bond, and the PSA, which governed the Bitcoin. There was no unified legal framework telling a regulator, an institutional investor, or a bond trustee how to assess Bitcoin as financial collateral under securities law. The disclosure standards didn't exist. The collateral treatment was legally undefined. Institutional mandates couldn't be written to include BTC-backed products. Large-scale retail distribution was essentially impossible in practice. The FIEA amendment resolves all of this at the foundational level. Japan's path to this moment was not sudden. It was a decade of methodical, sometimes frustrating regulatory progress. It started in 2014 with Mt. Gox. The regulatory vacuum was exposed. Japan had to act. In 2017, the Payment Services Act brought crypto exchanges under oversight for the first time. Bitcoin was recognized as legal property and a payment method. Between 2019 and 2020, crypto derivatives were partially brought under the FIEA, and the terminology shifted from virtual currency to crypto asset. In 2022 and 2023, stablecoin regulations arrived through PSA updates. Then, in late 2025, the FSA's Financial System Council formally recommended reclassifying crypto as an investment asset under the FIEA, the recommendation that set everything in motion. On April 10th, 2026, Japan's cabinet approved the FIEA Amendment Bill. On June 11th, the lower house passed it. Full implementation is expected in FY 2027. The tax reform, cutting the capital gains rate from 55% to 20%, follows in 2028. I find this timeline important. Japan doesn't regulate by fiat, it builds consensus slowly and deliberately. What it produces is durable, well socialized regulation with broad institutional buy in. This is not going to be reversed. So, what does the FIEA amendment actually change? Let me give you 5 concrete shifts. First, Bitcoin becomes a financial instrument. Bitcoin, Ethereum, XRP, and over 100 other crypto assets are now legally classified in the same category as stocks and bonds. This single reclassification is what unlocks Bitcoin as formal securities law collateral. A Bitbond prospectus can now describe Bitcoin collateral using the same legal language as a covered bond. Second, mandatory disclosure framework. Issuers now face annual disclosure requirements covering asset details, risk factors, and business finances. The same regime Japanese equity issuers operate under. Metaplanet is already ahead of this. It discloses its Bitcoin holdings in near real time. Smaller competitors will face compliance costs. Metaplanet has already absorbed. Third, insider trading prohibition. Bitcoin markets had no insider trading rules under the PSA. The FIEA amendment closes that gap. Many institutional mandates explicitly prohibit investing in asset classes without market conduct enforcement. That barrier is now removed. Fourth, capital gains tax reform. Currently, Bitcoin gains in Japan are taxed as ordinary income at rates reaching 55%. The amendment creates a pathway for a flat 20% rate, aligned with stocks and bonds, plus a 3-year loss carry forward. At 20%, the after tax economics of Bitcoin backed fixed income change completely. And fifth, a legal pathway for spot Bitcoin ETFs. The Japan Exchange Group is reported to be preparing crypto linked ETFs, potentially live by 2027. This expands the entire retail addressable market for Bitcoin linked products. Taken together, these 5 changes remove every major structural barrier that has kept institutional and retail capital out of Bitcoin native financial products in Japan. Now, let me connect the regulatory framework to what Metaplanet has actually been building. Metaplanet's management team, drawn from global investment banks and major domestic financial institutions, understood years ago that the critical bottleneck for Bitcoin native financial products in Japan was not capital, not investor demand, and not product design. It was the regulatory framework. Their response was to build every piece of required infrastructure in the window before the framework arrived. First, the Bitcoin Treasury, now 40,177 Bitcoin, that is the collateral base for every product that follows. Second, the Bitcoin income generation business, generating 10.78 billion yen in trailing 12-month revenue. That is the cash flow engine that proves the operating model. Third, the Mercury preferred shares, issued in December 2025 as Japan's first BTC-backed yield product. Proof of concept. Fourth, Metaplanet Ventures, the ecosystem investment arm seeding the Bitcoin financial infrastructure companies that will eventually be third-party issuers. Fifth, Metaplanet Asset Management in the US, the structured product design capability. And sixth, Metaplanet Securities through the SIBO acquisition, the Type 1 financial instruments business license, the distribution infrastructure. Each piece was built in deliberate sequence, and by the time the FIEA rules take effect in FY 2027, every piece will already be operational. That is not accidental. That is strategic sequencing. Before I make the Goldman Sachs argument, I want to explain what underwriting actually means, because this is the concept that makes the whole thesis work. When a company wants to raise money by issuing a bond, it faces a practical problem. It needs to find hundreds or thousands of investors willing to buy that bond simultaneously at the right price on the right terms. Most companies have no idea how to do that, so they hire an investment bank to underwrite the deal. The investment bank does five things. It structures the instrument, the coupon rate, maturity, collateral terms. It prices the deal, determining what yield the market will actually accept. It builds the investor book, contacting institutional buyers and gauging demand. It distributes the product, placing the bonds with buyers through its network. And in a firm underwriting, it guarantees the issuance, buying the entire bond itself and reselling it, taking the placement risk off the issuer's hands. The issuing company pays the bank origination fees, structuring fees, and distribution commissions. Here is the critical insight. The bank earns those fees across every deal it underwrites, not just its own financing needs. Think of it like a builder who constructs their own house, but also builds houses for everyone else in the neighborhood. The fees from building others' houses become an entirely separate revenue stream, independent of the value of the builder's own property. That is the model. Now apply it to Bitcoin Treasury finance in Japan. Goldman Sachs did not become Goldman Sachs by being the largest corporation in America. It became Goldman Sachs by being the firm that every other corporation called when it needed to raise capital. Goldman structured the deal, built the investor book, placed the bonds with its institutional clients, and collected fees on thousands of transactions across hundreds of industries over decades. The Goldman business model has three structural advantages that compound over time. First, the flywheel effect. More deals bring more investor relationships. More investor relationships bring more deal flow. More deal flow brings deeper expertise and better pricing. Better pricing brings more deals. Each transaction makes the next one easier and more profitable. Second, The information advantage, because Goldman sees deal flow across the entire economy. It develops an unmatched picture of where capital is flowing, what investors want, and how to price risk. That information advantage becomes a durable competitive moat that is almost impossible to replicate. Third, fee revenue independent of its own balance sheet. Goldman earns fees whether the bonds it underwrites go up or down in value after issuance. The revenue is structural, not directional. Now, and I want to be clear that I'm not saying Metaplanet will match Goldman in scale or breadth, but the structural ambition is directly analogous. Benchmark Equity Research put it clearly in their June 15th note. Metaplanet is positioned to, quote, underwrite the Bitcoin treasuries of others. That is the Goldman Sachs parallel, and it is not yet priced into any analyst model I have seen. Let me make the ecosystem underwriting thesis concrete with a worked example. It's 2028. The FIEA rules are live. The tax rate is 20%. Bitcoin ETFs are trading on the Tokyo Stock Exchange. A mid-sized Japanese technology company, let's call it Company X, has accumulated 500 Bitcoin on its balance sheet as a treasury reserve. Its CFO wants to issue a 5 billion yen BTC-backed bond to raise capital for expansion. Company X has a problem. It has never issued a Bitcoin-backed bond before. It doesn't know how to structure the collateral terms and loan to value ratio. It doesn't know what coupon rate the market will accept. It doesn't know which investors to approach. It doesn't know how to write a FIEA compliant prospectus covering Bitcoin collateral disclosure. And it doesn't know how to custody and monitor the collateral through the life of the bond. Company X calls Metaplanet Securities. Metaplanet Securities has already done all of this for its own account multiple times. It has the license, the structuring expertise, the investor relationships, the retail distribution network, and the Bitcoin collateral management infrastructure. It structures the deal, prices it, builds the investor book, and places the bonds. What does it earn? A 1% origination fee on 5 billion yen is 50 million yen at signing. A 0.3% annual administration fee on 5 billion yen outstanding is 15 million yen per year, recurring, for the life of the bond. Company X gets its capital. Metaplanet Securities earns fees. And here is the critical point. Metaplanet's own Bitcoin treasury is not involved at all. This is pure platform revenue earned from the ecosystem, completely independent of Metaplanet's own balance sheet. Now multiply the Company X scenario across the entire ecosystem. Japan currently has Metaplanet as essentially the only significant listed Bitcoin treasury company. But that will not be the case in 5 years. As the FIEA framework takes effect, as the tax rate drops, as ETFs launch and institutional adoption deepens, more Japanese companies will adopt Bitcoin treasury strategies. Each of those companies is a potential issuer of BTC-backed financial products. Each issuance is a potential Metaplanet Securities mandate. And here is where Metaplanet Ventures becomes strategically crucial. Metaplanet Ventures is already seeding the ecosystem. It has invested in JPYC, Japan's leading yen stablecoin. It is mandated to invest in Bitcoin financial infrastructure companies across lending, custody, payments, and settlement. Many of those portfolio companies will eventually want to issue their own BTC-backed instruments. Who will they call to underwrite those instruments? The firm that invested in them understands that Bitcoin Treasury structure, has the regulatory license, and already has the investor distribution network. That is the flywheel. Metaplanet Ventures seeds the ecosystem. The ecosystem grows. Metaplanet Securities underwrites the ecosystem's capital market needs. The fees are recycled into Bitcoin purchases. Bitcoin per share rises. The loop tightens. This is not a linear business model. It is a compounding one. Let me put some numbers around what this means for revenue and for BTC per share. First, the existing base. Metaplanet's Bitcoin income generation business generated 1 billion yen in FY 2024, 8.9 billion in FY 2025, and the trailing 12-month figure has already reached 10.78 billion yen. The full year FY 2026 guidance is 16 billion yen in revenue, with 11.4 billion in operating profit. That is the existing engine. The platform thesis creates three additive layers on top of it. Layer 1, own issuance. Metaplanet issues its own bit bonds, raising non-dilutive capital to buy more Bitcoin. The borrowing cost is below Bitcoin's long-run expected appreciation, accretive to BTC per share. Layer 2, platform distribution. Metaplanet Securities distributes Metaplanet's own products through the SIBO network. Distribution fees of 1 to 3% on placement volume. Layer 3, third-party underwriting. This is the new one. At 100 billion yen in third-party deal volume, illustrative fees at roughly 1.3 billion yen per year. At 300 billion yen, roughly 3.9 billion. At 1 trillion yen, still less than 0.1% of Japan's total addressable savings, the fee revenue alone approaches the scale of the entire existing income generation business. And every yen of that fee revenue, recycled into Bitcoin on the open market, raises BTC per share without issuing a single new share. This is why the Goldman Sachs model changes the valuation story. A pure Bitcoin treasury company's value moves with the Bitcoin price. A Bitcoin native investment bank with a Bitcoin treasury attached generates structural, recurring fee revenue that compounds BTC per share regardless of Bitcoin's price at any given moment. Those are two fundamentally different valuation propositions. Before I close, I want to be direct about the risks, because intellectual honesty is the only way to build a credible analytical framework. Risk 1, Upper House delay. The FIEA amendment has passed the lower house but still needs upper house ratification. Political disruptions or election timing could push back the FY 2027 implementation date. It's a low probability risk, but it's real. Risk 2, execution complexity. Metaplanet is simultaneously managing a 40,000 Bitcoin treasury, running an active options program, integrating a newly acquired securities firm, building an asset management arm in the US, and running a venture fund. Organizations that try to do too many things simultaneously sometimes execute none of them well. Risk 3, incumbent competition. SBI Securities, Nomura, and Daiwa are watching. If Bitcoin backed yield products prove commercially attractive, they have deeper distribution networks and larger client bases. First mover advantage buys time. It does not guarantee market leadership. Risk 4, Bitcoin price dependency. The entire collateral base of the Bitbond ecosystem is Bitcoin. A sustained bear market compresses collateral coverage and reduces issuance capacity. Conservative loan to value management can mitigate this, but not eliminate it. Now, what should you watch as the signal that this thesis is playing out? Watch 1. Upper House passage of the FIEA amendment. Watch 2. Metaplanet Securities' first third party underwriting mandate. The moment they underwrite a bit bond for a company other than Metaplanet, the platform model is validated. That is the Goldman Sachs thesis, moving from theory to evidence. Watch 3. BTC per share growth alongside Metaplanet Securities fee revenue appearing in quarterly results. When both are moving together, the compounding loop has begun in earnest. Japan has made its policy decision. Bitcoin is a financial instrument. The framework is arriving. Metaplanet built the infrastructure before the framework got here. The question now is not whether the opportunity exists. It clearly does. The question is whether Metaplanet can execute before a larger incumbent replicates the model. I'm Uncle Dividends. Thank you for watching.